Okay, so today what I'm going to record is a little illustration of how to go through investments case 2, which is what we were going to do in class until the gas leak happened. So you can see here in Canvas, here's investments case 2. You can click the template. If you click this, it will download an Excel file. And so hopefully you'll have that available for this illustration. The other thing is the reference material for this is in Unit 1 notes. You can kind of scroll down, and the example we're going to work is right here under section 3.4, buying on margin. We're going to work an example where we do what's called buying on margin, or using leverage to get a position that wouldn't be available without being able to sort of buy. We're going to buy more stock than we actually have dollar resources to buy, and sort of think about this example. So this example is kind of structured here in a way that I think makes sense to quick math-minded people, but there's some aspects of this that putting into kind of a spreadsheet way will help you think about what precisely is going on when we buy on margin. Related to this, what we'll also do is an example of selling short. That's in section 3.5 here, and this will be the same idea, except for kind of worked backwards. And so we're going to with kind of some of the same fundamentals for this problem. We're going to work problem with buying on margin, talk about what margin is, talk about sort of how to think about some of the calculations with this, and then do the same thing with short selling. So here's the spreadsheet you would open for the case, and this is kind of organized in a couple of different ways. Here on the left-hand side of the spreadsheet is basically the kind of accounting side of the spreadsheet. So you can think about your investment portfolio or your investment position as a balance sheet with assets and liabilities, and ultimately the equity is what the investor cares about having. And so we're going to kind of organize this in that fashion. The other bit in this problem that we have organized is some of the things that we care about. This isn't kind of organized in the kind of accounting way, but more in terms of the fundamentals of the problem and how these will feed in. And so what we're going to do is we're going to build a spreadsheet that references the assets and liabilities that we have at an initial price. You can see the different prices we're going to consider in this example. There's the initial price of 10. There's the possibility that after a period we sell it at 12, and that would be sold at a gain, which is a good thing for holding the stock. Or we could have kind of the bad state of the world where the price went down by 20%, and we're going to kind of ask sort of how does this look kind of without leverage, just as a base case, and then we'll add leverage to this situation. So start off with we're gonna, as a fundamental, have $5,000 to invest. Both of these problems that we have this as our base case, and so $5,000 to invest at an initial price of $10. That means that we can purchase 10 shares, and you can see that here that basically we have an equation that can take sort of the price per share, the dollars invested, and then this tells us how many shares are feasible. It's 500. I didn't hard code that in. I actually made it so that it was available in here. Next thing is, this seems like a bit of an unnecessary step. We'll explain kind of the initial margin part of this, but this is just to kind of embed. If you have $5,000 to invest and you're not borrowing any money to kind of augment what you can purchase, well, you still just have $5,000 to put into this position, and so that's why we're referencing this cell called investment balance rather than the amount to invest. So let's kind of take like the next step and say, okay, actually not take the next step. Apologies. We want to fill in the balance sheet, and we want to be really almost pedantic about this. What is the initial assets that you have in this portfolio? Well, we have $5,000, and these are really, it's actually 5,000 shares. It's not actually cash, but it's dollars. What liabilities do we have? Well, we borrowed 5,000 minus 5,000. We borrowed 0. You can see that you've got your assets and your liabilities. How much equity do we have in this position? That's just going to be assets minus liabilities. If I've got my accounting right, this is the sort of the bottom line in my investment portfolio. This is sort of how much money I have initially. It should be how much we put in, but that kind of gives you a sense for how we can fill out this balance sheet. Next step is to say, okay, let's say some time passes. We're at the end of a holding period, and we're potentially going to liquidate our position, but the price went up to 12. Well, how many shares do we have? That doesn't change. Still 500 shares. We're not really thinking about amount to invest as like a thing, but I guess then the question is, well, what is now your investment balance? Well, you have 500 shares. Now each of them is worth 12. So you get 500 shares times $12 per share. You have $6,000 now. Again, here's your so your amount borrowed is still 0. You didn't borrow anything, and what you can see is that that's how the position changed. So if we reference the what happened in terms of a balance sheet in our sort of new position after the price change, we can see that now the investment balance is 6,000. We still have liabilities of 0, and I can just copy down here equity because it's always going to be that assets minus liabilities equals equity, or really the ultimate investment balance in the account. So you can see that we get we have $6,000 in the account. What we want to point out is that if we do this calculation of, well, what's the percentage return, this should match. So we sort of ask, how much did the price change? Went up by 1,000. How much did we invest initially? That was 5,000. That's a 20% return. That 20% calculated on sort of the bottom line, in the case of no leverage, actually does match the 20% increase in price. And so you can see there that the percentage return is the same as the price. And so we can do the same thing. I'll run through this a little bit more quickly. In the event of a price decrease, we have 500 shares still multiplied by a price of 8. That gives us 4,000. We've still borrowed 0. And so you can see that, see if we've still borrowed 0, we get our balance sheet looks like this. Really simple balance sheet. There are no liabilities on this balance sheet, only assets. The assets are stock, and when we liquidate, that stock turns into cash. And so we are, I think you can think about this as being sort of almost spending a bit too much time to kind of go through this, but showing you like the really basic case of when we're working with no leverage. And so that's maybe perhaps how you think about investing in the case when you can't when you have no access to leverage. Now suppose instead, as in the example of 3.4, that we can buy on margin. What does it mean to buy on margin? Well, what it means to buy on margin is that we have an amount to invest, but we also have an amount that we can borrow, and the amount that we can borrow is up to an initial margin of 50%. Now, what is initial margin? And there are sort of requirements that the brokerage firm is going to stipulate, but you can only borrow so much. They're not going to allow you to borrow 99% of your investment because they're going to be on the hook for sort of allowing you to do this. So they like to sort of stipulate that you have enough skin in the game, that you put 50% of the investment. So 50% of the investment, where can you see that? Well, 50% of the investment is kind of right here. You can see that the way you can figure out what your investment balance is if your initial margin is 50% is that you can say, well, here my amount to invest is going to be then divided by this initial margin, and then that gives you, that tells you that you can borrow up to, well, how much? You can borrow 10,000 minus 5,000. In this case of initial margin of 50%, you're able to borrow another 5,000 with the $5,000 in cash that you put up. Okay, so what does that mean in terms of your balance sheet? Well, now your balance sheet has some liabilities. You're borrowing money from this bank, who then is going to sort of hold also the assets on your balance sheet, kind of as collateral for covering those liabilities. In practice, they're going to charge you a rate of interest on what you're borrowing, and this rate of interest depends on sort of your credit worthiness, but then also potentially the sort of the riskiness of the investment activities that you're pursuing. And of course, the bank is covering themselves by imposing an initial margin requirement that really effectively puts a limit on how much you're able to borrow. If we were to change this initial margin requirement to say that you only need to provide 20%, notice then that would allow you to borrow more. If you were to tighten it so that you had to have 80% initial margin, you can see that you could borrow less. 50% initial margin actually is pretty close to in line with what you can do with a leveraged position. Now, the important part about this is that your initial price, at the initial price, you're able to invest in, with margin, you're able to sort of double, in this case, how many shares you have access to. But note that if I were to sort of liquidate this position, I would still only have $5,000 as my bottom line. I owe $5,000 and I have $10,000 in stock. That really means that my bottom line, I have $5,000 in this account, even though I have exposure to $10,000 of stock. So what does this do in terms of affecting our returns, in terms of just thinking about like the ultimate effects of this on the returns that we can expect as an investor? Well, first, notice that here we do have 1,000 shares as the price moves around, and let's take the case where the price goes up by 20%. The price goes up by 20%. I still have 1,000 shares. Those 1,000 shares now become worth 12 times 1,000, now 12,000. So we can see that changes my assets to be $12,000, and so that's gone up by 20%. But notice that the effect, or what's happened, is that the amount I have borrowed, well, that remains the same. And maybe there's an interest cost, so we would add a nominal amount to this, but that interest cost doesn't depend, it doesn't kind of go in proportion to what happened to the price. You're basically just, you have liabilities of sort of $5,000 because that's what you borrowed at the outset, right? So $5,000 there. And so now what you can see is if we do assets minus liabilities to get equity, well, now we end up with an ending balance of $7,000 on our initial investment of $5,000. So let's compute the percentage return. Get $2,000 of capital gain on a $5,000 investment. That's a 40% increase in the price. Now, recall what we had before in the position without leverage was that we had another situation where we could have had loss, and we're considering kind of that was symmetric. We saw a 20% gain and a 20% loss. Here we can see that there's a 40% gain when the price goes up by 20%. So having leverage in this initial position gave us greater exposure to the upside. Turns out it does the same thing on the downside. Here you can see the 20% decline in the stock's price. You can see that what you end up having is there's assets minus liabilities. You get a drop in your bottom line investment account of $2,000. That ends up equating to, and here I'll just go and do the equation. Here's the capital loss, $2,000, spread out over $5,000 of initial investment, and you get 40% loss. And that's something that, like, what happens is that if you use leverage in your investment, and you can gain more exposure to the stock, and that ends up amplifying the returns both on the upside and on the downside. What would happen if you did 10% leverage? You can see that you get even greater exposure. And here, even in this case, you end up with negative equity in your account. That's something that can't really happen in practice. You should read the notes. But in practice, what will happen is once your equity in your account drops to a small enough value relative to the assets, that is, your maintenance margin goes far enough down, the bank will then force a sale of your stock, and that's what's called a margin call. So, kind of more realistic values of leverage. You can see that there's your percentage returns for the example that we worked in this case. So hopefully that gives you an idea of how to fill out the buying on margin part of this. I'll return in a separate video to guide you through what's going on with short positions.